Hello, this is Coach Mike with WinningStockCoach.com. Going to start with my weekly market overview for the trading week ahead, the week beginning January 5th, 2015. One thing I've been really consistent with over the past several weeks is that 2102 target area. In last week's video, I actually talked about that how even though we made that weekly close above a swing point after this, dip we had over here, that I still wouldn't really get all excited about long positions unless we broke the 2102. And that's really where I'm kind of at. I was waiting for that break and we didn't get it. And we did come within our standard 0.5% of market highs and lows. And this would be the 49th consecutive time, if you watch the whole series of videos, that been within a 0.5%, which was a little shocking when we were down here, because this dip here the week of December 8th was kind of like, well, shoot, I wasn't within a 0.5% that time. And when it quickly popped back up the next week, it said, you know what, I'm going to still trust that 2102. And if you've watched the videos each week, you've known I stayed consistent with that. But I do want to say that I don't necessarily think that the market's going to crash. So don't get me wrong. First off, I am a very, very systematic trader. And also, I want you to recognize that this upcoming week is the first full trading week of the new year. Really, it's the week that might kind of shape the markets over at least the next month or so. And with earnings season approaching, I wouldn't be surprised if it was a down week. But, one thing that I'm also pretty consistent with is not doing the one thing that hurts most traders, which is thinking. I just react. When I try to think or rationalize, just like most traders, things won't make sense. And I'm not in the business of trying to rationalize. I go after it and I make money. And I've got a proven record of doing that. So what I want to say is, if we do get some continued down move, again, I'm in no means saying, oh, the market's going to crash and the world is over. I would be looking really around this 1966-64 as the target area. And you might say, well, there's two little red targets on your chart, Coach Mike. And yeah, you're right. There's this 1894.95, but in all reality, it's got to get below the 1966-64 first. And the other thing to understand is that if we do get an up move, this target area that I said last week was warranted on the chart after this dip and rip right here. But I said that I didn't really think we had a chance to just giddy up and go straight there. If we started to make an up move at this point, once we break that 2102, that really becomes a target we're going to have to trust. And, where most people have sat for the last several years saying, this market's just it's just too far up there and everything's overvalued. And they keep missing out on trade after trade after trade. I make money. Doesn't matter if the market goes up or down. My trading strategies give me the ability to make money in either direction. What they don't give me the ability to do is try to rationalize. I simply react based on the accuracy that the charts have given over and over and over again. And before I go start trying to convince somebody else or even myself that, oh, this is going to be the year the market crashes and it's going to start this week, we have some downside targets that we would have to look for first. And before the market could crash, it would have to hit each of those targets. So, let's just take one step at a time, one foot in front of the other, and understand that if we make a down move, that first downside area we'd be looking for is right there. And actually, I'm sorry, it's 1986.64, not 1966.64. And if we were to break the 2102 area, 2231.37. Now, if we do make more of a drop than what we made back on December 8th and back into December 15th before it really got up again, if we exceeded the level of that drop, then that 1894.95 would be where we'd be looking. And if you just wanted an honest opinion, I think it's likely that we could hit that 1894.95. But I also know that before it hits that, again, it has to break below the 1986.64. Over now to the DJI chart. That's the Dow Jones Industrial Average chart. You'll see first this first area, this 17,865.07. This was a previous target we used, and we got right up into it, started to pull back, and we barely broke it a couple weeks ago and came back below it again. Anyway, very similar type pattern to what we see in the S&P 500 here on the DJI. And one thing we kind of need to understand at this point is if we were going to pick a downside target with some further pullback, we'd want to be looking at 1719 or 17,179.84. And if we were to break the swing high point or the weekly close point from the week of December 22nd, that 18,053 and 71 cents, we would really have to break that point to be able to look up here at the 19,000s, 19,203.66. But I won't be surprised at all, not one bit, if we come down on the Dow into this lower target area. And let me tell you why. Financial stocks are going to be reporting earnings starting the middle of January, and almost every single time we get into the start of the earnings season or the major earnings season, that real first week of the kickoff, even though there will be some random stocks that report earnings sooner, you kind of have that big block where, boom, financials are all reporting this week. And, when we get into the reporting for Goldman Sachs, I believe it's on the 16th or 17th of January, almost every quarter it pulls back into the earnings. And right when it looks like it's going to pull back hard, Goldman Sachs delivers again, and then boom, the Dow goes up. A couple weeks later, Visa will report, and if it goes like last quarter, it'll go up a little too much. But I don't want to get carried away and look at this 16,607.93 right now for the Dow, simply because I believe any pullback it's going to do, you would want to trade it just based on, it's been 19 straight quarters for Goldman Sachs where the Dow has actually done exactly what I'm explaining right now, where it'll look like, man, this thing's going to get ugly. And right when you think it's going to get ugly, Goldman Sachs reports its quarterly earnings, and boom, here we go again. So it doesn't have to be 20 straight quarters. It's been 19 so far. But it's the fact that it's been 19 straight quarters that you might want to see how it reacts first and not look too far to the downside, because every single time it has looked ugly. It has looked like, oh, wow, this is going to fall apart. And then boom, it starts with Goldman Sachs earnings every single time. We had that back in October. The market was pulling back hard into mid-October. Goldman Sachs reported earnings and the market went up. Now, I am not saying, so don't confuse me or blast me on Twitter or whatever, I am not saying that I believe Goldman Sachs is the reason the market keeps running. No, but there's only 30 stocks in the Dow Jones Industrial Average. And when that one reports, being one of the larger stocks, it creates movement in the Dow Jones Industrial Average, that composite, if not just for that day, maybe for a week or two. And it's been something that has been so consistent that one can go back and compare the dates of the earnings on Goldman Sachs and see that every single time, here we go, we had a big pullback into October, you get down middle of the week, Goldman Sachs reported earnings, here we go again. 19 straight quarters. So until it does something different, you almost have to assume that that's what it'll do. But I also want to tell you, don't go being stupid with Goldman Sachs earnings saying, well, it's done at 19 straight quarters, it has to do it again, because the premiums on the options are already starting to inflate a little more than normal. So to try to get that preemptive options play, especially when you're going to be paying almost double the premium that you should be paying, or you would be paying if it wasn't the earnings time, puts a lot more risk on your side, to where, you know what, I've always played Goldman Sachs after earnings, and I'm not wrong in that aspect. The last earnings, it actually gapped down on good earnings, but then took off from there. I bought the calls once the earnings report was out, huge trade, and it's worked out every quarter. So if we start to get a pullback in the Dow, understand that you can't set your sights too low for that pullback, at least until we see how the market reacts after that time where the earnings season starts. Now, if it's just a snowball effect, bad earnings after bad earnings after bad earnings, well, then yeah, trade what you see. But let's get into that earnings time frame, get into the middle of January where stocks start reporting their earnings, before you start getting some wild hair and some genius idea that turns out to be the worst idea you ever made. We talked last week about the Russell 2000 and how it finally made a new weekly high close. First time since March. I guess you could say June. It did close higher here in June, but really we had this double top feel going into June. Then we came down and made a lower low. And we had, if you watch the videos, several weeks of going, wow, small caps are just boring as all get out. And yes, the Russell 2000, the RUT, that's the small cap index. And then last week we said, hey, we did break above that point, which could create a momentum trade. And there's one particular thing I told you guys to watch for in your small caps that would indicate whether your momentum was going to be there on that potential breakout play, and that was volume. And it was a holiday week for one, so the volume was lower. But the fact is still that the volume was lower. Because the volume was lower, you didn't sustain the breakout move. Now you got to look for the Russell 2000 to hold a support area of 1182.43. That's the high close here in this consolidation time before it had a little dip, before it ripped. And as long as we can hold that 1182.43, I don't think you want to get in the short side of small caps. If you fail that 1182.43, then you might want to start thinking more towards that short side. But in reality, because last week was a holiday week and the volume was so low that its candle doesn't even really matter. And you can almost say that for the week before, even though that was the breakout candle. It was Christmas week. It was a holiday week. The volume was super, super low, almost like it doesn't really matter. And because of that, again, like I said when I first started this particular video recording, that we want to kind of sit back at the start of this week. It's the first full trading week of a new year. We want to understand that this week could really kind of shape out how the markets do trend towards over the next couple months. And we need to understand that that period could be just like January of 2014. We came out of the gates and you saw the Nasdaq start to curl over, and it curled over and made lower lows and lower highs until almost the end of March. We could possibly see that. I'm not one to say that we will or won't. I'll simply react if we do. But we want to make sure that we understand that, well, we could wait a couple days, or we could screw ourselves over for a couple months by getting too antsy and not taking the proper precautions to trade what is happening as opposed to what we think might happen. So really what we kind of got to do on the Russell 2000, we've almost got to pretend the last 2 weeks weren't there. They were low volume weeks. We had to give Christmas week the credit because of the breakout, but when we didn't have the volume and we didn't continue, we didn't get the momentum trade, it became quite evident that it was fairly non-existent. It became even more evident in the fact that last week's candle basically retraced the entire move that the previous week had made. So it kind of nullified it. So as we sit right now, we don't want to jump short. Even if we start to get a down move, we don't want to go short instantly in small caps because the chart overall hasn't really given us that bearish indication. It's actually done everything to tell us that if things go well, you should go bullish, look bullishly at small caps. But we have to get that volume confirmation for the momentum trade, the breakout trade. And until then, be a little bit patient. Finally, we're going to move over to the NDX. This is the Nasdaq 100. And if you remember from last week's video, I talked about how in relation to the S&P 500 and the Dow, it looked almost like it was a week behind. It was just shy of breaking that swing point, which was where we were the prior week for the Dow and the S&P. And I said, if the Dow and S&P come out and have a really good week after they had already broke those tops, let's look at the NDX and say, hey, this could continue and it's just lagging, and kind of get that 1 week advantage to being able to almost see the future. Well, if you look at what it's really done here, you also have to say, well, you know what, this could be a lower high now. And you would also want to say, I need to be patient for just a little bit longer, because if it closes that week below 41.9928, that lower low confirmation is going to set us up just like what we were at last year when we had that big fall and everybody said, oh, the Nasdaq's taken the biggest fall since the tech bubble in 2001.
The end of the world is here. And then what did it do? It skyrocketed on the new highs. But we do want to be cautious that we could get into a couple month period where it's not so friendly to long positions. Let's watch for the lower low, because we have to respect that without a doubt, those last couple weeks, these two green candles here, they did not break the high that was set a month before then. And because of that, it did give us a lower high, which would, on the average, give you an expectation of a lower low. So if we start to break down below that 41.9928, it's actually this chart that is set up as the most bearish for short-term stuff. It's obviously the overall trend has been very, very steep and upwards. But for that shorter term aspect, if we start to get a down move early in the week, for members of the coaches roster in our chat room, it'll be the Nasdaq charts that we really go after and attack. And if you think about it, we already started doing that last week with Apple and Facebook that had big downfalls in them. Apple, we just killed it with Apple with our 50-50 trading system and several things called out in the chat room. We made that jump on Apple because of this lower high. There were other stocks that weren't NDX composite stocks that went down, but why did Apple go down the most? It was the one that had the most bearish arguments against it, as opposed to ones that, well, it did just make a higher high and higher low. The Nasdaq composite made the lower high. And it was because of that we wanted to attack those stocks, because they gave us the higher probability of not just having a winning trade, but having 3 different trades from our 50-50 trades that went for 490%, 595%, and 635% in a 4-day period, simply because of the recognition of the higher probability area based on a chart like this. So as you approach the upcoming trading week, just remember that for your Dow Jones Industrial Average, your S&P 500, you need to at least give it a few days to see how it starts to shape, to see if you don't just turn around and start going. If it does look bad for the markets the first day or so of the trading week, your NDX chart, your Nasdaq 100, is giving you the most bearish outlook for the short term, at least because of this lower high, thus giving you a higher probability of producing winning short trades if you get the continued down movement, where something like our Russell 2000, the RUT, that did go up and make that higher high, has a little bit of leeway that you have to give it before you go short in small caps, or else you could just barely fall just a little bit, get a bounce, get torn apart on your shorts because you didn't follow the higher probability trade opportunities. This is Coach Mike from WinningStockCoach.com, encouraging you to always have a plan for your trade. Understand that when it comes to a stock's movement, stocks will trade heavily in correlation to the equity indices. And if you understand the equity indices that will have that effect on your stock and include it into your trade planning, the total percentage of trades that you enter that result in winning trades will drastically improve. And if you check out the coaches roster at WinningStockCoach.com, the profit per trade could really blow your mind.